Patel with Palisade Radio. Today we're kicking off the relaunch of Palisade Radio to mark our one-year anniversary and over 100,000 views to date. We've put together an all-star lineup of industry experts that include Jim Rogers, Doug Casey, Eric Sprott, Rick Rule, Frank Holmes, James Turk, and today on the show with us is renowned investor Marc Faber. Marc, thanks for joining us.
It's my pleasure, thank you.
Marc, you need no introduction, but for those listeners that do not know, Marc resides in Thailand and is the publisher of the widely read newsletter The Gloom, Boom, and Doom Report. He's a repeat guest and commentator on CNBC and Fox Business News, and that brings me to my first question. Marc, you recently appeared on CNBC where you called for an imminent crash in the U.S. general equities to occur in the second half of 2014. You pointed out that certain sectors of the market are well off their highs, such as airlines and social media. Are you sticking to your prediction of a crash?
Well, I didn't say that the market would crash, but I argued that since the market hasn't had a more than 11% correction since October 2011, in other words, soon 3 years, it was likely that we would not just have a correction, but something more serious, like a 20 to 30% decline.
And in your career, you've witnessed several corrections and crashes. It's often the case that bull markets go on longer than many investors believe to be possible. How do you gauge when a bull market has run its course and reached its peak in making a prediction?
Yeah, this is a very good question, and this is absolutely true, that bull markets frequently go on for longer than expected. But the fact is, the current bull market is already very old by historical standards. We've been going up steeply since March 2009. In other words, the bull market is more than 5 years old. The economic recovery in the U.S. got underway in June 2009. So also the economy has been in an expansion for more than 5 years now. And the one thing I can say is we are in an aging bull market, and the economic recovery has lasted longer than the typical recovery or expansion phase over the last 100 years. Now, can the bull market go on for a while because of additional money printing? Possible. But in my view, for asset prices to continue to go up, the Federal Reserve would have to actually increase the asset purchases and not taper. And that is maybe politically quite difficult to do.
And that's exactly my next question. If there is a correction or a crash, what type of reaction do you expect the Federal Reserve to take? If the stock market starts to pull off, do you believe the taper will be reversed?
Well, as you know, the Federal Reserve, each time there was a problem, they flooded the system with liquidity, starting essentially with the tequila crisis in 94, LTCM in 98, the dot-com crash after March 2000, and the housing bust after 2007. So I suppose that they would again try to support asset markets. The only problem in that is, as you know, one of the problems of this expansion, which has been by historical standards very modest in terms of its momentum, and it hasn't really trickled down to a large segment of the population. One of the problems is really that because of the expansionary monetary policies and the asset purchases, numerous assets are not affordable by the majority of people. So if the Fed decided to print money in order to support asset markets, the impact may be actually negative on the economy because prices would start to rise.
While the general equities are hitting all-time highs, some sectors such as gold mining equities are at multi-year lows. I understand that you're bullish on some mining equities. Talk about mining and maybe any other sectors that you believe are poised to rise.
Well, I mean, if you look at a broad number of asset classes, bonds, equities, real estate, art prices, collectibles, commodities, in general, the prices are elevated. Of course, I'm aware that gold has corrected from $1,921 down to a low of 1180, and now we're around 1300. But in general, asset prices are much higher than they were, say, 10 years ago. Real incomes in the United States for the typical household are down. In other words, prices have gone up more than wages. Now, the only asset class that, in my view, appears relatively and absolutely depressed are gold mining shares and silver mining shares. Because if you look at the Dow Jones or the S&P, and then you look at, say, the GDXJ, which is the Junior Gold Mining Index, the underperformance has been colossal. And even large mining groups like Barrick or Newmont Mining have tumbled and are at the stressed levels. So as a contrarian or as a value investor, you would have to say, okay, these are not momentum stocks. They are building a base, but here I find some reasonably good value compared to other asset prices. Don't forget, now yesterday, the German 10-year Bund traded below 1%. The French government bonds are yielding less than U.S. treasuries, which are yielding. The treasuries in the U.S. 10-year notes are trading at 2.4%. So all these assets, government bonds, equities, and so forth, are essentially inflated, whereas the gold mining sector is deflated.
Many metals investors, remembering 2008, fear that a crash in the general equities could send the mining shares spiraling downward, even as they're at multi-year lows. For the past 3 years, the mining shares have been negatively correlated to the general equities. But if a crash occurs in the general equities, do you see the negative correlation holding and the mining stocks actually going up?
I believe that, say, if the stock market dropped more than 20%, the Fed would step in. Actually, I wouldn't be surprised if the Fed didn't step in after a 10% correction. In other words, that would be close to 200 S&P points. But on a 400 S&P points decline, for sure the Fed would again implement asset purchases. And I think at that time, gold could really take off. And because junior mining stocks and the large ones, due to their high leverage, are a leveraged play on the price of gold, I think, yes, they could go up if stocks declined.
Mark, you live in Thailand. I would imagine that living in Asia and being deeply involved in finances has given you a unique perspective on the Asian mentality towards precious metals. It's obvious that there's been an influx of gold into Asia over the past few years. However, what is unclear is if Asians are buying more gold or if the metal is flocking there to avoid political risk back home. What's your take on the movement of gold from west to east?
Well, basically, it's very interesting. It's a very interesting situation because we have in the West rumors of gold market and silver market manipulation by most likely central banks that want to depress the price. And on the other hand, the Asian sovereign funds, central banks, individuals are buying gold. And so you have to ask yourself, what is actually the motivation of Western central banks to depress the gold price? Because their interest would be to sell gold at as high a price as possible to the Asians, but that is not the case. But I think in general, we have had over the last 10, 20 years, especially following the Asian crisis of 97, 98, a huge increase in wealth in Asia, in central bank reserves, in sovereign funds, in private wealth. And if you have $1 billion, what is it for you to put, say, 10, 20, 30, $50 million in gold? So the increase in the demand for gold from Asia comes from a growing population, and population that has become increasingly affluent.
And finally, I know you've mentioned the Hong Kong stock market is a good investment right now. However, if the U.S. stock market tanks, how will that affect the other equity markets around the world? Do you expect Asia to take a beating, at least temporarily?
Well, I think that most stock markets in the world are correlated to the U.S. market. I mean, if the U.S. S&P drops 10%, 200 points, for sure, other markets will also go down. Now, is it possible that because of a weak economy in China, the Chinese also print money, which is a possibility? If they did that, then the yuan, in other words, the Chinese currency, could weaken. But in this scenario, I think that stocks would go up, because you mentioned before that gold hadn't been correlated with the S&P. That is correct. For the last few years, since 2011, gold has gone up and the S&P has gone up. Same for Chinese stocks. They've been essentially underperforming the U.S. since 2006. And so my belief is that if China decided to print money and the currency weakened, money would flow into equities. The other reason why I'm reasonably positive, certainly relatively speaking to the S&P, is that the valuations in Hong Kong are relatively depressed, because you can buy property companies that sell at a discount of 40 to 50% of the net asset value. Now, the net asset value may not be correct, because property prices in Hong Kong could continue to decline as they have over the last 12 months. But still, you have some cushion of security. Moreover, Hong Kong shares have a relatively high dividend yield compared to other markets. So I'm just saying, if someone says, I'm very bullish about the U.S. stock market, then I would rather own Hong Kong shares than the S&P, because you have better value.
On that note, I urge listeners to visit gloomboomdoom.com to subscribe to Marc's newsletter. Thanks a lot for your time, Marc.
It's my pleasure. Thank you very much. Bye-bye.